Every firm incurs a cost of financing its investments. In this last presentation in Section 3, we're going to demonstrate how to compute the cost of capital for an entity. You'll learn how to calculate the cost of debt, equity, and total financing. Total cost of capital is made up of two components. The cost of debt capital, which is nothing more than the annual interest expense that results from borrowing money, and the cost of equity capital. This is the return a firm theoretically pays to its equity investors to compensate for the risk they undertake by investing in the firm. First, let's look at the cost of debt capital. Let's assume Extreme Edge borrowed $100,000 at the beginning of 2017. The weighted average cost of debt capital, assuming no income taxes, for 2017 equals total interest expense divided by the total interest-bearing obligations. So in this case, the interest expense would be $10,000. Total interest-bearing liabilities is $100,000. So again, assuming no income taxes, the interest expense divided by interest-bearing liabilities gives us a cost of debt capital of 10%. If we assume a 40% annual income tax rate, the cost of debt capital would be adjusted as follows. We would take the interest expense of $10,000 and multiply that by 1 minus the tax rate of 40%. And then we would divide that by the $100,000, leaving us with an actual cost of debt that has been adjusted by income taxes of 6%. The cost of equity capital approximates the cost of common equity based on its opportunity cost. In other words, the rate of return investors give up by taking an equity position in the firm. This is the rate of return on a riskless investment, in other words, the risk-free rate of interest, plus a risk premium given to the company's equity based on its risk. The risk-free rate of return typically equals the interest rate on federal government debt, in other words, US T-bills. And the risk premium is a market-determined interest rate that we add to the risk-free rate. So in our example, assume that US Treasury bills, in other words, the risk-free investments, were paying 3% interest and that Extreme Edge's common stock carried a 5% risk premium. The cost of common equity capital then would be 8%, the 3% plus the 5%. There is no tax adjustment for equity capital because dividends are not considered a deductible business expense. Now let's calculate the weighted average cost of total capital. We combine the cost of debt financing with that of equity financing to determine the weighted average cost of capital, also called the WACC. The WACC then equals the percentage of interest-bearing debt times the net cost of debt, plus the percentage of common stock times the cost of common equity. So in our Extreme Edge example, to calculate the weighted average cost of total capital, we would first combine the two components of firm financing and allocate a percentage of financing to each component. So we had debt of $100,000 and common stock of $418,000. The debt then represents 19.3% of the total, and the common stock represents 80.7%. That totals $518,000 or 100%. We would then apply those percentages to each component's cost of capital and add them together. So here we have debt of 19.3% at 6% cost of debt capital. That gives us a weighted average of 1.16. Common stock, 80.7% at 8% component cost, or 6.46. So the weighted average cost of capital for Extreme Edge in this example would be 7.62%.